Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. And there's just an hour to go until the closing bell. Right now, stocks mixed. The Dow down about 280 points. Your broad gauge, the S&P 500 down about 0.2%. Your tech-heavy NASDAQ, that's up about 0.1%. Let's welcome in here. We have our Washington correspondent. That would be Ben Werschkul. Got our data and markets editor, Jared Blickery, helping us to break down all the headlines. Jared, my friend, over to you first for the latest on the trading action so far today.
Thank you, Josh. I think the name of the game today is rotation, as it was last week, but there is a different kind of rotation. And today we are seeing the Dow down 275 points, or 0.6%. And here is the NASDAQ. It's up. And so the NASDAQ and the Dow have kind of switched positions from what I was seeing 1 week ago. Friday kind of changed things a little bit. Most things went up on Friday. But here we see the NASDAQ began in the red and drifted into the green, or shot into the green, just kind of drifted back down here, not too far from the unchanged line. I'll show you the S&P 500 too, down about 0.2%, almost got positive at one point in the middle of the day. And the Russell 2000, the small caps, those are leading the way down, down about 64 basis points, or 0.6%. And we got to check in on the bond market before I get to some heat maps here. The 10-year yield up a whopping 1 basis point, nothing to write home about, and the 30-year just about unchanged. So let's take a look at the sector action. Now, as I said last week, we had some other sectors, not tech. Tech was holding down the NASDAQ, but energy switched places last week, and it is in the forefront today. Communication services, tech, and consumer discretionary, those are the three sectors, or four in the green. Staples, healthcare, and utilities, those were leading last Monday and Tuesday. Those are the worst off today. Utilities off by about 1.5%. When we take a look inside the NASDAQ 100, split field regarding some of the mega caps. Tesla notably up 2%. Nvidia ahead of those earnings we're going to see Wednesday, that's up almost 2%. Alphabet up over 1%. But let me just give you a look inside tech to show you what's going on here. Here's software. Not a lot of green on the screen. Adobe, Oracle, just some small gains for them. Here's the semiconductor space. We're seeing a lot of the larger issues and some of the medium ones, those are in the green, already hit Nvidia, but Taiwan Semi up 1.5%, so is Lam, so is KLA, just a little bit less than that. And China's also working today. So China's kind of uncorrelated with a lot of US markets, and so this can go up or down against the grain any other way. But check out the Dow here. Unlike last Monday, which was more green than red, this is almost all red today. Nvidia is the exception, so is Nike. Nike up about 1.33%. And then I'll show you the transports as well. Transports are worse off than the Dow and worse off than the Russell 2000, led down by some of the railroads here. American Airlines also down about 4% there. And when you take it into consideration that this is probably the last week of summer before school, before things kick off into the fall, we're just seeing money rotate. And I think that explains a lot of the price action that we're seeing this week and last.
And over to Washington now. All eyes watching Intel as a possible case study. The White House no longer just helping regulate tech, it's taking ownership in the space since the Trump administration announced a 10% equity stake in Intel. It's a critical moment that has investors wondering, where could the government go next? Ben, help us understand here what this precedent means exactly.
For sure, yeah. I think what you were definitely hearing from the White House today is they want this Intel deal, which was now a couple days old, to be a template for future deals. You saw multiple comments from Trump as well as from Trump's team about how they want, as in Trump's words, many more Intel deals, many more deals along similar lines. Where, as the Intel deal was, the U.S. government took a 10% stake in the company. Without board seats, but an equity stake in the company in return for what were previously government grants. The key open questions here are sort of how much the government wants to be involved day to day in these companies, in Intel and also in possible future companies. This deal notably does not include a board seat or things like that. But what we saw from Trump today is that he is now heavily invested personally in Intel's success. As he put it, I wanted them to succeed before, but now I want them to succeed even more so because of this deal, which is a little different message than we saw from Trump's team, which was that the government's not going to get involved in the day-to-day operations of Intel. So that's one big piece of this. The other big piece I think that's notable today is kind of what other companies Trump could make a deal with. From Trump's commentary today, there was an acknowledgement that other semiconductor semiconductor companies are less inclined to make a deal. Taiwan Semiconductor, AMD are two companies that are receiving CHIPS Act money but are clearly less inclined or in less of a position to need to give up equity stake to the government. So what we have is Trump talking about applying this template to a lot of other areas. How many of those come to fruition in the months ahead remain to be seen, but it's clearly on his mind. He likes the idea of this 10% stake and a kind of government investment in Intel, possibly in their operations.
And Ben, in terms of big picture, the reason that the White House is making for this, has it been changing at all, Ben? Like initially, it seemed to be a lot of talk about national security. This is about chips, and chips are the backbone of the modern economy now. Looking ahead, and hey, the U.S. has to remain in the lead there, tip of the spear. Is that the same argument, or has it been evolving here, Ben?
I think it's been evolving a little bit. I think the overall message of chips and why chips are so central to the Trump administration, as well as I'd note the Biden administration, who initiated a lot of these, what were then government grants and then became equity stakes, is this national security argument. This is what they really want. Why the government needs to be involved in chips broadly. Democrats and Republicans want to do it differently, but that's why it needs to get involved. I think that what's evolving a little bit is sort of why Intel became this deal. I think it's essentially, I think the Trump team doesn't acknowledge this directly, but you kind of can get it reading between the lines that Intel was willing to give up this. As Trump said, I want to take as much as I can of this, and Intel is willing to do it because of the tough position they found themselves in. That's, as I mentioned before, that's a very different position than Taiwan Semiconductor would be. So there is an opportunity here from Trump's perspective to get involved in Intel that may not be there with others, but they clearly want to do as many of these deals as they can in the months ahead. And
as they look to make these deals, Ben, I'm an investor and I'm listening to this right now. I'm thinking, hey, I wonder if the United States government's going to take a stake in my company. What do we think they're broadly screening for exactly, Ben? Are they looking for companies that rely on, Uncle Sam funding? Or are they looking on companies that rely on Uncle Sam for regulatory clearance? What is it exactly?
I think it's this CHIPS Act money was the clear leverage point that Trump had. This is $11.1 billion that was committed to Intel by the Biden administration as a grant. And then Trump was able, partly because money was already outstanding and partly because Intel was not in a position to push back against it, that he could kind of convert this to equity. What it means kind of overall is that he really wants this aspect to be his focus. But how it applies, Trump is clearly aiming to use his leverage points in as many areas as he can. I think regulation is a good one to watch. As you mentioned, in the months ahead, Trump is willing to get involved in public pressure campaigns. He's willing to sort of fast track permitting processes. U.S. Steel is another example that the U.S. government has gotten closely involved. Nvidia is another one. So there's lots of different ways he's looking to use leverage in the months ahead.
All right. Thank you, Ben. Thank you, Jared. Appreciate it. Markets have been jittery around tariffs and Fed policy, but there may be a bigger story, including a wave of corporate cash flow and productivity gains that could drive stocks higher. And all this, of course, set amid the backdrop of AI giant Nvidia reporting earnings this week. There's a lot to unpack here with recent market activity. We're bringing in Nancy Tengler, CEO and CIO of Laffer Tengler Investments, along with Unlimited co-founder, CEO and CIO Bob Elliott, joining us for the hour. Nancy, I'm going to start with you. You talk about how the bears, you say, Nancy, are wrong for now. Let's start there. Why is that, Nancy? What do you think the bears have wrong?
Well, thanks, Josh, for having me. Good to be on with you, Bob. I guess they are not factoring in the positive effects of the One Big Beautiful Bill Act. And that is really cash that's going to go directly into corporate coffers due to 100% expensing, R&D credit, which is a one-timer, but bonus depreciation. And so when you have that in as a tailwind, that can be a powerful offset to tariffs. We also saw that more margins did not shrink across the board materially, if at all, during the last quarter. And a recent Kansas City Fed survey has about 55% of the respondents saying they expect their margins to increase slightly or stay the same. So this disaster that tariffs have been projected to be, at least for the moment, have not yet happened. And we don't have investors really factoring in the benefits of what we call at Laffer Tengler, the Obama bill.
Bob, I want to bring you here as well. The big, beautiful bill. So Nancy sees a tailwind there, Bob. Now, I will say, just to play devil's advocate, we have a lot of smart economists on this show, Bob. I do often ask them about the big, beautiful bill. And I say to these economists, listen, how stimulative is this going to really prove for the U.S. economy? Oftentimes, Bob, I get kind of a muted response. I don't hear a lot of excitement. But what do you think?
Well, the main thing with the one big, beautiful bill is that it was mostly a continuation of existing policy, particularly around tax policy. And so while the political rhetoric was very positive about it, it was really, instead of providing a substantial tax break to households and businesses, it was mostly just averting what would have been a tax hike. And so what's left in the bill is a set of relatively modest benefits to businesses related to what was just being described. I think the challenge is the thing that drives businesses typically to invest is that they see a lot of demand. And right now, when you survey CEOs about their desire to invest, or you look at some of the ISM and regional Fed surveys, demand to invest right now is quite weak. And so while there is some incremental benefit when it comes to expensing, without the strength of the overall economy supporting significant investment, we're not likely to see much investment relative to what would have happened otherwise.
Nancy, what do you make of that? Demand for invest, Bob's pointing out, looking a little lukewarm here.
I would respectfully disagree. First of all, the cash benefit is going to be about $150 billion for the top 400 in the S&P 500. So where's that cash going to go? Much of it will be going back to shareholders and to CapEx. But also, if you look at the demand for what we've seen in terms of CapEx, I mean, business CapEx is up 3.2%, and that is mostly, well, it's driven by Mag 7 CapEx. And so when you look at that, that's 24% of S&P CapEx. And what we know from the companies is this is going to continue. We're hearing complaints from many of the hyperscalers. They can't get enough chips. They can't build out quick enough for the demand they're seeing. So we would expect to see, and by the way, that all pales in total economic CapEx of over $4 trillion annually. So we expect to see that continue to accelerate. And we think that this bill, and I agree with Bob, a lot of it was just extensions of something that we've already experienced. But the three that I mentioned are critical, and I think will drive significant CapEx, as well as one of the things you can't quantify are the benefits of deregulation.
Can I ask you, Nancy, because the first time I had a chance to chat with you since then, Friday, the big move we saw, I mean, stocks just roared because they listened to Jay Powell in Wyoming and they said, hey, they think he just suggested a policy pivot. Did that move make sense to you, Nancy?
No, it never does. And that's why I hope in the new world of Fed speak, we'll go to less speaking and more just letting the market digest the minutes and all of the things that are put out by the Fed. So no, and because I don't think that's what he said. And he has said many things over the years that he has then reversed on subsequently. So I'm much more focused on earnings. I'll take it when the market goes up and down in big swings because volatility is the friend of the long-term investor. So, we had been trimming and then buying back a number of the names that got clobbered in August. And so that for us was a great day, but we'll use further weakness when he says something else to add to the long-term holdings that we have in our growth and value portfolios.
All right, Bob. So Nancy says, listen, I mean, Fed officials, they do tend to talk a lot, Bob. I mean, Fed speak comes and goes. Focus on earnings. So on that point, Bob, Q2 earnings season, what'd you make of it?
Well, I definitely agree we could do with a lot less Fed speak in our lives. We'd all be a lot better off there. So hopefully it trims back a little bit. I definitely agree with Nancy on that. When it comes to second quarter earnings, I think it's a bit difficult to read, particularly because some of the drags that we're likely going to see from tariffs are really only starting to affect the companies and then the end consumer there in the second quarter. And so, we really only got implementation of tariff policy and a ramp up really at the end of that second quarter. And so it's really going to be the third and fourth quarters where we're going to get a real feel as to how much of that drag is going to hit businesses and households from the tariffs. And when you look broadly at the second quarter earnings, the main thing that sticks out to me is most of the growth, most of the upside surprise is happening in the AI names, tech, and finance. And when you look at the real economy earnings are pretty modest. And in order to get the sort of earnings, the sort of double-digit earnings growth that are expected over the course of the next year or two that could power stocks higher, we've got to see a rotation from AI tech boom going on to the real economy. And we have yet to really see that play out.
Nancy, what about Bob's take on there on the earnings season, what we heard, and maybe some bifurcation there?
I mean, I think for the most part, he's right. Our investing theme has been old economy companies that are pivoting to the new technologies. I've talked about it on your show. Walmart's a poster child of a company that's embraced all of the technologies. And we're seeing it across sectors. So our team, we distribute coverage based on economic cross sections. And what we're hearing from across all sectors is implementation of AI and benefit. So this MIT study that said nobody's getting any benefit from AI was sort of mystifying to me, because we're hearing from the companies that they are hiring less or producing more or doing more with less. And so I think that's exactly the kind of productivity driven growth that I've drawn the analogy to for the last 40 years that we saw in the 1990s when I was managing money, and the technology, the internet was not nearly as robust as what we have now. So I'm pretty excited. I think we're going to continue to see upside surprises, but that's always with us, because Wall Street analysts have a hard time estimating earnings. 83% surprise this time, but to me the more important number was 80% of the companies beat on revenues. That was important.
Nancy, always great to see you. Appreciate your time. And Bob, you are sticking around. Thank you. We are just getting started here on Market Domination. Coming right up, Elon Musk lashing out with legal action against Apple and OpenAI. We'll be explaining his latest beef there. Plus, Nvidia reports Wednesday, but there may be a number of bottlenecks ahead that can disrupt growth. We got you covered on what to expect there. And some airlines flying high while others struggling. We'll have those stories and more coming up after the break. Stick with us. Apple and OpenAI facing a lawsuit from Elon Musk's social media platform X and artificial intelligence startup xAI. Musk companies accusing Apple and OpenAI of engaging in an illegal anti-competitive scheme. Yahoo Finance's Alexis Keenan joining us now with a closer look.
Yeah, so this is a case that X and xAI are bringing in a federal district court in Texas, and it's an antitrust allegation. And what the two companies are saying is that that agreement that Apple and OpenAI announced at the Worldwide Developers Conference in June, saying that ChatGPT, so OpenAI's chatbot, that it will power Apple devices, specifically will be integrated as a first-party chatbot into iPhones, laptops, desktops, and the iPad, not necessarily the iWatch, but across a lot of Apple's devices, right? And what X and xAI are saying here is that is an anti-competitive, unfair competition problem, both under federal law and under Texas state law, because they're putting those two things together on the smartphone to power it to the exclusion of other chatbots. Now, what the complaint says is that Apple is holding on to and trying to maintain its 65% share in the smartphone market. So there's two different markets at play here, so which is really different for an antitrust suit. On the other hand, you have OpenAI, where X and xAI are saying that the company has at least an 80% share of the market. And by the way of this agreement, they're trying to hold on to those markets. Now, another problem alleged here is that others really can't match the scale, right? Because if you throw in ChatGPT to train on and get prompted by Apple users, where there are millions, if not maybe billions of prompts every day, that's only going to fuel it to improve to the detriment of its competitors. That, they say, is an antitrust problem. Others can access, though, users can access other chatbots on the Apple devices, but Musk and X and xAI are saying, well, that has to be done via an app or through the browser. And that's not the same as that first-party integration. So that's what this lawsuit is about. We do have a response from OpenAI saying this latest filing is consistent with Mr. Musk's ongoing pattern of what they call harassment. Also brought up in this lawsuit are kind of some shades of the Department of Justice's allegations against Google in the Google search case, and how Apple was so integral to that case because of the agreements for Google to run its search by default on Apple devices. So kind of switching parties here, but the lawsuit definitely brings that up and says, well, that's kind of the problem that the DOJ didn't like.
So what is Musk, Alexis? What's he want? What's he asking for? Does he spell it out?
He does. He wants an injunction. He wants the court to step in and stop this agreement from going forward. And he also references billions of dollars in damages. Now, those are not specifically quantified in this complaint, but that would, I guess, take a lot of very fancy financials in order to put that together. But he does reference billions of dollars in damages. Still a lot to learn here. This is just first blush. Next will come the discovery
I meant
phase.
to ask you, next. So I was going to ask you, next steps. What's next here?
Yeah, so if this does go forward, if this suit goes forward, it could always get tossed out on a motion to dismiss. That's the standard operating procedure, right? Is that OpenAI and Apple would go in and ask for a judge to get rid of this case on a number of grounds that they can decide which are proper here that they think. And if that doesn't happen, that's when the discovery would kick in and the judge would say, well, these claims can or can't go forward. But certainly a lot to contend with here. Both of these parties, Musk and OpenAI, already in lawsuits and entanglements that have been ongoing for almost a year now.
Yeah, and Musk on X, he kind of suggested this one was coming.
Yeah, he did.
He was breathing fire. Thank you, Alexis. Appreciate it. When Nvidia reports second quarter earnings Wednesday, Yahoo Finance will cover the earnings and the call live in special coverage, followed by an interview with CEO Jensen Huang. The report comes amid a flurry of moves between the company and the Trump administration, with Trump revoking his prior ban on the sale of chips to China, but his administration will now require the AI giant to pay the government a 15% cut of sales in China. Here with more, we got Gil Luria, D.A. Davidson, head of technology research. Gil, it is great to see you as always. So listen, Nvidia earnings on deck, Gil. I'm curious what you expect to hear. We did hear from those big tech giants recently, Gil, who said, listen, they're going to keep spending on AI CapEx. That should be good news for Jensen Huang's company, no?
It is good news. And more broadly speaking, the fact that the AI tools have gotten so good and that we're all using them so much more for more things tells us that we're going to need more compute. If we need more compute, we're going to need more data centers, we're going to need more GPUs. Big picture, that's all that's really important for NVIDIA, and that will be reflected in this quarter. There are complications around the relationship with China. That's not going to go away anytime soon. The news flow there is daily, but big picture is still very positive for NVIDIA.
You do mention, Gil, the sort of cross currents here with China, lots of headlines. If I'm an investor in NVIDIA, Gil, do I just have to simply bet, okay, CEO Jensen Huang, not only a gifted executive and an entrepreneur, technologist, but also I think has shown his chops as a true diplomat. Do I need a bet, Gil, that, listen, at the end of the day, ultimately he's going to find a way through this?
Yes, to some extent, but it's not even necessary. Again, the magnitude of demand right now is such that NVIDIA will continue to be able to grow even with a choppy Chinese market. We're not going to know how many chips they can sell into China anytime soon. We thought they couldn't sell H20s, and now they can, and now they have to pay a tax on that. And then the Chinese government is encouraging domestic companies not to buy it. Then we're going to get into conversation about the B30 and what the specs are going to be around that, and will they be able to sell that? And are there going to be tracking chips? And are the Chinese going to consider that backdoor? That drama isn't going away anytime soon. And so investors have to just incorporate that into their analysis, realize that China's going to have its ups and downs. The rest of the business is on a good trajectory, and you can tune out the noise from China. And then to your point, nobody's been able to maneuver this better than Jensen Huang so far. So you can put some trust in that as well.
Bob, bring you here as well. I'm just in bigger picture, Bob, this Nvidia print on Wednesday, how important is it for the broader AI trade and trend? How important is it for the market, Bob?
Well, I mean, most of the support to the earnings season, the outperformance relative to expectations has been in the AI-related names here, and Nvidia obviously wraps that up here for the second quarter. I think the big question is for Nvidia is just how far can the hyperscalers go? You know, you've got hundreds of billions of dollars of investment going into building new data centers and buying chips. And the question on the other side is, are the users of this actually seeing enough of a benefit to make the economics of all of that investment work? It's one thing when everyone's racing for being the front runner. There's another thing whether all that investment is actually going to pay off in the end. And so I think that's sort of the question. The broader question here is, over a couple-year time frame, does all this investment pay off, or are we seeing a lot of speculative investment that's going to go to waste?
Gil, how do you answer that? I mean, all this AI spend, where is the ROI, Gil?
So the two levels, right? So let's use our favorite analogy, the gold analogy, right? So Nvidia is making picks and shovels. Microsoft, Amazon, and Google are buying those picks and shovels and renting them out, right? And right now there's a line around the corner to rent picks and shovels, which is to say Microsoft, Amazon, Google are getting an okay ROI. It's not great. It's not as good as the rest of their business, but it's okay. The true question, to Bob's point, is, are the gold diggers finding enough gold? And the answer to that right now is absolutely not. There's not enough incremental revenue and costs eliminated because of AI to justify this level of investment. But having said that, the way we're using these tools has such a promise in terms of driving productivity in such a huge way that it does look like if we continue on these paths and we all become so much more productive because of these tools, we will be able to justify this investment down the road, whether it's 2, 3, or 5 years down the road. The math right now from usage isn't working. Really, most of the usage is chat, and there's some software and maybe a little bit of elimination of customer service, but definitely not enough to justify the hundreds of billions of dollars we've invested to date. But if we can all become more productive, this becomes a driver of economic growth. In retrospect, we will be able to justify these investments.
Gil, heading into this print, we just flashed on screen here, you're still on the sidelines. You got a neutral. How come, Gil?
Yeah, I mean, we came from a point earlier this year where we thought this would be the peak year for CapEx investment and the next year was going to be a decline. We no longer think that. We think that the development in the models over just even the last 6 or 9 months, the increased usage that's starting to manifest itself has justified the increase in Nvidia's stock price in this time frame. Right now, they're trading at the high end of their forward multiple historical range. The growth going forward is going to be somewhat capped by other factors, but we're definitely not as concerned as we were about the consumption peaking right now. We are more positive on Nvidia, but the valuation now probably reflects that properly.
Gil, always great to see you. Thank you for your time.
Thank you.
And don't miss our special coverage of Nvidia earnings and the call. It starts Wednesday at 4:15 Eastern. We'll also bring you a live interview with CEO Jensen Huang. Tune in for that at 6:40 p.m. Eastern. All right, now time for some of today's trending tickers. Unlimited co-founder Bob Elliott is joining me here for a look at Tilray Brands, Okta, and the airlines. Let's start off with Tilray Brands. That stock surging as Jefferies lifts its price target to a street high, raising it from $1.50 per share to $2, Bob. Bloomberg does say that's a street high. Analysts talking about improving sentiment on cannabis reclassification. They say Trump's endorsement of reclassification could sway lawmakers, Bob, who have historically been resistant to reform. They say rescheduling offers a political middle ground versus full-scale legislation. Most on the street, it looks like here, are still on the sidelines. They're to hold, but Jeffries, they say it's a buy, Bob.
Well, I think we're in a pretty important transition here in terms of cannabis being normalized, essentially. After really years and years of being commercially viable, but running under the radar. And so, if you could start to change the economics around even the payment infrastructure, the ability to access, basic services, all the different things that have been, a lot of these companies have been locked out on. And Tilray is, they frame themselves as the Coca-Cola of cannabis. And so, they're probably the front runners because they've got the scale globally to really take advantage of an opening up of the market in a market that otherwise is highly, highly fractured.
Yeah, you also think about this shift we're talking about here, Bob, and obviously investors are also thinking about knock-on effects, what it means for alcohol companies, at least those that don't have exposure, right? Interesting trend. Yeah. All right, moving on. Let's get Okta getting an upgrade at Truist as it raises its rating on that stock from hold to buy. The firm noting the company is approaching an inflection point. So, all right, on this one, Bob, Truist goes to buy. Their fans had their earnings results. They say Okta approaching inflection point. Its platform resonating with customers. They say well positioned to consolidate the identity market. They talk about the large install base. Expect solid earnings result. Their target looks like it goes to 125.
Well, I mean, security is obviously a critical infrastructure point for any business, and Okta has been one of the front runners in that market and taking advantage. When we talk about who can actually take advantage of the AI revolution and a sort of a first order effect, what they've been able to put together and it is really indicative of that. Of course, there's the question of down the line, which we just talked about, who else is going to be able to take advantage, but these sort of first order companies that can really leverage the AI infrastructure to be able to run more efficiently, they're certainly one of them.
Yeah, it's stock up nearly 20% this year. Finally, let's get a look at Raymond James because it's hitting American Airlines with a downgrade, raising though their rating on Alaska Air. So a couple names here, Bob. Raymond James. Looks like they take Alaska to outperform. The target is 70. Concerned about the complexity of the business model, its wide-body aircraft exposure, but they say they have a great appreciation of the airline's measured approach to taking on this risk. They do downgrade American, though, to market perform, so they move to sidelines there, a more balanced risk-reward. What do you make of the airlines broadly? I'm just looking at the ETF, Jets. I mean, it hasn't done much year to date, but nice move off that April low for sure.
Yeah, I mean, the airlines in general are really indicative of the services demand that you see in the economy, and there's some questions about whether services are going to hold up here through the second half of the year, particularly as consumers and businesses start to get hit with the tariff impact flowing through. The challenge under the hood is that there's some big winners and losers in the airline market. American is the worst of the big three and incredibly challenged with putting big bets on Boeing to deliver and them failing to do so. Whereas you see an up and coming Alaska Airlines with their Hawaii merger, they're really starting to take over a significant number of routes here. Routes that had where there's shrinking competitiveness, and that's really advantageous for their business.
All right, pick your spots. Coming up, President Trump wants more couches and bookshelves made in America. We're digging into what the future of furniture import tariffs may look like. Now, stocks are responding to that threat. Furniture stocks, Wayfair, RH, and Williams-Sonoma fallen today after President Trump suggesting furniture imports would face futures tariffs. Yahoo Finance senior markets reporter Inez Ferre has the story. Inez.
Yeah, Josh, and the investigation that the Trump administration is doing will be a 50-day investigation, and then they will determine the rates for tariffs on imported furniture. This seemed to come as sort of out of left field as far as these tariffs are concerned and the impact that they will have on furniture importers. This also comes on the heels of a tough couple of years for the entire industry because you've had a stagnant real estate market. You've had discretionary spending that was hit, at least on the lower income scale. Also, a lot of sort of spending more on services than on actual goods. And then you've had these companies that have really tried to dodge tariffs because a lot of these stocks were in April lows when Trump unveiled the tariff policy that he had, and then it sort of evolved from there. And then you saw these stocks that recovered since those April lows, also on the expectations that the Fed is going to be easing rates. And so there was some recovery there. But now for some of these stocks, at least these companies that are importing from abroad, this creates a lot of uncertainty as to how this will shake out and what the actual tariff rate will be from a country, let's say Vietnam, and if that tariff will be different than the actual tariff rate on that's already applied on Vietnam, if the tariffs for imported furniture will be higher.
And Inez, listen, I'm an investor. I'm listening to this. I want to know, okay, what are some of the names or the subsectors that are going to be more exposed to the tariff threat than others? Like, who are the potential furniture winners and losers here, Inez?
Yeah, so you've got furniture winners, so to speak, the ones that make most of their products in North America, whether it be in the U.S. or whether it be in Mexico. So you have Lazy Boy that, for example, today, that stock was up. Ethan Allen Interiors, that was also up because they have about 75% of their manufacturing that's in North America. Then you have others like RH, which has been moving a lot of its manufacturing outside of China towards Vietnam and more towards North Carolina in the U.S. That stock was down. You have Williams-Sonoma that also has been shifting quite a bit of its manufacturing. That stock was down as well. I want to make a note on Wayfair because Wayfair stock was down today 7% at one point. And Wayfair is seen by the street as more of a marketplace. But of course, they have a lot of suppliers who have been also, again, shifting a lot of their manufacturing outside of China into other Asian countries. And so the stock is up more than 50% year to date because of cost restructuring that they've had at the company, et cetera, and also just sort of a bottoming, so to speak, of the market. But there's been a lot of competition among the suppliers within these sort of marketplaces as well. And they have been reluctant to raise the prices on a consumer that's already over the last couple of years been strained and been not shopping for as many goods and more services.
Yeah, a lot of important cross currents there for that sector. Thank you, Inez. Appreciate it.
Thank you.
The shares of Best Buy slipping ahead of second quarter earnings, falling alongside other discretionary stocks as the Dow and the S&P 500 do remain under pressure heading into the close here. Join me now, we have senior reporter Brooke DePalma. Brooke.
Josh, good afternoon. What we're seeing here as Best Buy is set to report Thursday before the ballot's second quarter earnings report, largely based upon Bloomberg consensus estimates. It is expected to be another quarter, the second consecutive quarter of same-store sales decline when it comes to Best Buy's second quarter report due to this ongoing pullback of those big ticket discretionary items like appliances and consumer electronics that consumers have just been pulling back on as we make way into 2025. Another thing that analysts are looking out for is commentary around the back half of the year. Joe Feldman of Telsey Advisory Group cited in a note that Best Buy is expected to, hash over easing comparisons and also AI newness around that could help boost computing and mobile phone sales. In addition to that, newness, innovation like that Nintendo Switch 2, that's also expected to boost sales in the second half of the year, especially around that holiday season. And the third thing here is any sort of commentary about the launch of Best Buy's marketplace that launched just last week. That third-party marketplace will give it more insight, or rather more opportunity to dive into products that it isn't able to sell in store with those third-party sellers, similar to what we see on Amazon as well as on Walmart.com, as it looks to make an edge up against the competition and really stay in the game here. We do know that also those alternative profit streams have been super successful for retailers, so all eyes will be on its ad business and that key marketplace.
And Brooke, finally here, before I let you go, what do we think Best Buy is going to tell us about tariffs?
Yeah, well, we do know that in the first quarterly earnings call, they did cut their guidance around revenue, adjusted earnings, and same-store sales growth. And Wedbush Securities emphasized in a note that they expect that they will reiterate that guidance largely, which includes the impact of tariffs. Across their call back in May, there's been lots of trade headlines, including that extension on China. We do know that the company sources from China, Mexico, Vietnam, South Korea, and Taiwan. But one of the biggest things that investors say has been key here is their switch, or rather shifting production, especially from that key China market. Back in March, about 55% of the products, the cost of goods sold, were sourced from China. Back in May, that was down to 35%. And so we expect to hear more about that on the call.
All right. Thank you, Brooke. Appreciate it. Coming up, the IRS is putting the brakes on time. It's giving electric vehicle buyers a small extension to secure a tax credit. We're going to tell you everything you need to know when we return. Stick with us. EV buyers are getting some wiggle room to claim tax credits after the September deadline. For more, we're bringing in Yahoo Finance's senior reporter, Praz Subramanian. Praz.
Yeah, Josh, a little bit of breathing room here for EV buyers. You know, the law, the OBBB said that basically on September 30th that the credit would be going away, and if you didn't take delivery by then, you wouldn't get the credit. But now the IRS has some new guidance here talking about how if you have a signed contract and you put down a deposit, you don't need to take delivery by the 30th. You can actually take delivery at a later time and put it in use. You just have to file a report with IRS saying that you actually bought the car, you completed purchase of it before, but you received delivery of it later. So, you know, that's a big deal because, you know, we saw in July, the latest data, we've seen EV sales were surging, up 26% month over month and 20% year over year. So kind of lifting the EV market share at almost at 10%. So, you know, that combined, that kind of level of sales means that inventory is falling and people might not be able to buy or get the car they want in time for that deadline. So what this gives them a bit more time and also more money for EV companies to sell their cars. So you get a little bit of extension there with that deadline.
All right. Thank you, Praz. Appreciate it. Well, the gap is widening between new and used EV prices. A report from our next guest showing that used EVs are selling at 45% discount compared to their new counterparts. We're navigating how to play the EV sector with the Yahoo Finance playbook. And joining now, got Tom Narayan, lead equity analyst of global autos at RBC Capital Markets. Tom, it is great to see you. So when we talk, Tom, about the EV slowdown, we'll talk about different factors. You know, maybe it's politics or range worries, but you're focusing on a different variable, Tom, which is used prices for EVs. Walk us through it. What are you seeing there?
Yeah, it's interesting how this, I think, is being forgotten a lot by the market and the media in some cases. There's a lot of focus on culture wars and range anxiety. That gets a lot of attention. But when you really look at what's driving the EV slowdown, we think it has to do with used EV pricing being so much below new EV pricing. So much so, as you pointed out in that chart, it's like a 45% discount. If you can get a Tesla Model Y for $13,000, why would you buy one for $50,000, right? Whereas on the ICE side, right, internal combustion engine side, the discount between new and used is only about 25%. So what we're noticing is really, and we're seeing it in the data, if you look at California vehicle sales in 2024, the new EVs fell off in 24 versus 23, but used just absolutely spiked. So much so that you can't ignore that type of data. It's clear that what people are doing is they're seeing the deals that you can get on used EVs, and they're buying the used EVs instead of the new EVs.
So let me ask you, if that's the trend, then as investors, how do we want to be positioned to play that theme? Who are some of the winners you would call out from it?
Yeah, we think that what this trend means is that this EV slowdown has legs. It will likely continue, right? Because you're going to have new EV prices go up because of tariffs and whatnot. Also, you had a lot of people on leases, right? They leased an EV back in like 2022 post-pandemic. Now it's 2025. 3 years have gone by, and it's time to return that car, and they're buying a used EV instead of a new EV. So we think this continues. Who do we like? We like the legacy OEMs, that's like Ford and GM, who can sell internal combustion engine cars. We like those guys. We also like auto suppliers that are tied to those legacy OEMs. Suppliers that are tied to Ford and GM. Who are we worried about? It's the pure play EV guys, maybe your Rivians, your Lucids, to a lesser extent Tesla, although we think that stock trades on other things. But really you want to own, I think, names that benefit from internal combustion engine sales, and less so on companies that are completely dependent on EV sales.
But correct me if I'm wrong, Tom, GM and Ford, I thought you had an outperform on GM and a set to perform on Ford. Is that still the case? And if so, how come?
Yeah, that's true. And that's a lot of that just has to do with kind of comparing the two against each other. We do like GM more than Ford right now for a number of reasons. But the thesis on Ford, we're kind of warming up a little bit to it, honestly. And a lot of it has to do with this dynamic itself. The fact that the EV slowdown continues. Now they don't have to sell as many EVs. They can sell more large SUVs and pickup trucks, which are cash machines. So if that continues, we could change our view on Ford potentially. Right now, it's just more of a relative bias towards GM right now, but that's definitely warming up.
And you also talked, Tom, there, I heard you mention the names you thought, okay, that could be disadvantaged by this EV slowdown, and you mentioned some of those pure play EV names, the Lucid, the Rivians, but I know you still like Tesla. Why do you still like Tesla here, Tom? Is that the new affordable model on the way in Q4? Is it the robo-taxi play? Explain it to us.
Yeah, I think this one has less to do with cars at all, right? And it's very much to do with the robo-taxi. Also, you know what's been really I'm getting calls on a lot lately is humanoid robots. If you asked me this, I think you did ask me this maybe a few months ago, I would have been like, I don't know, I need to do some work on it. But the more I'm reading on it, the more the market seems to be warming up to obviously AI and on this humanoid robot topic. This has some legs too. So I think the reason why I like Tesla is I do think there's a lot of growth here in non-cars. So while I am worried for them on car sales because of the EV slowdown, I do think, and especially from the retail investor point of view, there's a lot to potentially like on the AI play, especially with robo-taxi and this humanoid robot theme.
Final question on the EV slowdown, Tom. Talk to me about the European OEMs.
Yeah, that's actually really interesting to look at. In Europe, you're not seeing an EV slowdown nearly as much as you do in the US. They have to sell these for CO2 compliance and regulatory. But that said, these companies are still losing money selling EVs. So that's why I'm actually more constructive on the US legacy OEMs. They get to sell pickup trucks and large SUVs. In Europe, fine, there is demand for EVs. It's not the same problem here, but remember, they have this Chinese threat. The Chinese OEMs are already in the European company's back door. They're already selling EVs cheaper. It's just a much more competitive dynamic there. So while there is EV demand, it's just really competitive over there. I really think you can kind of hunker down and look at the legacy OEMs in the US.
Tom, we're always lucky to have you on the show. Thank you for your time and those picks, sir.
Yep.
While wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.